Um, no, it's not at all. What we've been seeing is increasing tremors. It's actually started around January, February. That's when we had a VIX tremor. Then if you remember, around March, April, we had TED and overnight spread tremor. Then around July, August, we saw some of the more marginal emerging markets. And now we have a much broader waterfront. The reason for all of that is very simple. We're drawing down liquidity and trying to raise the cost of capital. When you try to do that against the background of one economy doing well, which is the US, and the rest of the world either contracting or certainly not growing as fast, you will generate enormous amounts of volatility. And in fact, I would argue, unless Federal Reserve stops and or unless China alters direction, you're going to get a lot more volatility as we go forward.
So that was going to be my next question then. What's next? You mentioned the tremors that we've seen over the last few months, over 2018. Are we headed for an earthquake then, in your opinion?
Ultimately, yes. If in fact, essentially you either reverse macro settings or you need to change micro settings. And the macro settings essentially are all about liquidity, cost of capital, growth and inflation. And the micro settings, it's all about earnings expectations and the multiples. If macro settings cannot be changed, primarily because Federal Reserve, Donald Trump and China do not see eye to eye, then micro settings have to change. And today, pretty much any market you look at, expectations are 10, 15% earnings per share growth rates, not for 1 year, but for 3 years, 18, 19 and 20. Analysts do not expect any dislocation whatsoever. And the multiples have to some extent corrected, but pretty much no market is cheap. So either you change macro settings or you change micro. And what the market is deciding is basically macro settings are not going to change, so we're going to change micro.
Viktor, talk us through what's happening in terms of this sort of higher cost of capital investors. Talk about the state interference aspect of this, because how much of an impact is that going to have on your strategy?
Huge. Enormous. I think the view that China is unique and everybody else is free and liberal and capitalist economy are completely outdated. The allocation of capital is directed in China, but increasingly it is also impacted in the West as well. So from my perspective, trying to understand or preempt what the governments will do or what the public sectors will do is really going down the rabbit hole. You don't know where you're going to come out. So my preference has always been try to look for the best performance, the top 5% performance, no matter what sector you happen to be in. They might be expensive, and they usually are. But on the other hand, they have cash flows, and those cash flows will grow. Whereas a lot of value stuff really are deteriorating. It's a diminishing value exercise. It's assets that are going to fall over time rather than rise over time. So my argument is, yes, state is here to stay. It will get much more aggressive. It will interfere with trade. It will interfere with allocation of capital. It's already been interfering with forces in the money markets, in the currencies. That's going to get deeper. So the way to do it, in my view, is to get out of this noise and focus on the best performers.
Okay, well then, where do you invest in that climate then that you've outlined? Which particular asset class looks, I guess, immune from the volatility that you've just outlined?
None of the asset classes are immune. It's just some are going to do better than others. If volatility continues, it's going to spread to other areas. It's going to spread to mortgages, to real estate. It's going to spread to car loans, to credit card loans. So nobody is immune. I still think US dollar-denominated assets are a better place to be than either emerging markets or a high-yield debt. I think high-yield debt is incredibly vulnerable. But in terms of individual stocks, instead of thinking of sectors, think of stocks, think of companies. I think that's a much better way to go forward.